Dave, I'm seeing this all over social media. I don't know why, but the young people are gravitating towards these universal life policies, and here's how it's marketed. They go, you're supposed to use your life insurance while you're alive. Did you know that? And everyone's like, oh my gosh, this is brilliant. This investing policy inside of my whole life. Oh my gosh, this is amazing. I'm going to become a millionaire. And the commissions and fees these guys are making selling this crap is insane.
Yeah.
And the amount of time you have to spend pulling that premium every single month in order to make any amount of money is absurd.
Well,
I don't know how it's legal.
The indexed universal policy is it's a newer version of an old bad idea, is what it amounts to. And so what you're going to find if you take this product apart and look at the components of it, the insurance portion goes up every year. It's basically what we call an ART, an annual renewable term. Term insurance, all life insurance gets more expensive every year that you're alive, period, because you're statistically more likely to die every year you're alive, right?
Brilliant.
So if you're 51, you're more likely to die statistically than if you're 50, period. Okay, end of story. Now, how do you get then a 15 or a 20-year level term insurance? Well, it is cheaper than the average of the 15-year of increases. The ART would start out cheaper and it would end higher, and the lines would cross right in the middle, hypothetically, if it was exactly how, you see what I'm saying? So the ART would go, it'd go straight up, and the 15-year would be level, and it would cross right in the middle at 7.5 years. However, it doesn't do that because it is cheaper for an insurance company to produce a 15-year policy because they keep you for 15 years. Then it's called persistence in the insurance business, than it is for them to try to get you to stay with a policy that goes up every year. Can you imagine that if you get a bill and every year it goes up, you're probably more likely to cancel that? So that policy doesn't stay on the books, so it's more expensive for them to sell ARTs. So net result is a 15-year is way cheaper than the average of 15 years of ART. Okay? Now, the index universal goes up every year inside the policy, but you don't see it. So if you got a $400 premium, a certain portion, like on your, if you ever look at your mortgage payment, a portion goes to interest, a portion goes to principal. The further you go along, more goes to principal, less goes to interest. This is exactly the opposite. The further you go along, more goes to insurance, less goes, because the ART is going up every year inside there, less is going to your investments. And so if you keep the stupid thing long enough, it will begin to be the point that the premium you're paying will not even cover the insurance cost.
Oof.
And so it starts to eat back into your savings just to keep the policy alive. And the thing gets what we call upside down in the insurance business. And so now you've got a real piece of crap that's eating itself from the inside out.
But they pitch it as this really sophisticated, nuanced.
Listen,
it's so complicated you don't understand. Just trust me.
Yeah.
As your insurance guy, I'm going to make you lots of money.
Let me give you a clue. Okay, when you drive past most cities, the skyline has banks and life insurance companies. These are the two towers in every skyline. Santa Claus didn't build those. And those people didn't build them with wealth they inherited. They built them with money they took from you. Banks screwing you. Life insurance companies screwing you. This has been going on for decades.
Nothing new.
It's not a new song, not a new dance. And just because you put it on TikTok, for God's sakes, doesn't make it smart. Matter of fact, that kind of dumbs it down.
Dave, that's a trigger word for you. I'm sorry. I shouldn't have mentioned
right.
anything.
I mean,
but
it's just like...
What we teach is that you should take the difference. That if you pay $5 for term life versus $100 for whole life, take the $95 you would have spent and invest that, and you're going to be way better off than having touched one of these crappy policies.
Yeah. Oh, here, by the way, after you paid extra on this all these years and you die, they only pay the face value. They don't pay the face value plus your savings that you've been paying extra to build. So it's like a savings account with a crummy rate of return.
They get locked up.
That when you die, they keep your money. I mean, who would bank with that? Oh, people that buy stuff on TikTok.
I think Danny needs better friends.
Yeah, well.
It's time.
No, I mean, that happens to everybody. Because that's how most, particularly whole life, permanent life, crappy life insurance is sold, is some old friend from college suddenly remembers you.
My buddy from Northwestern Mutual said,